So thank you for having me. First, a little bit about SeedInvest, and then I'm going to get into basically crypto securities regulation 101 in a second. About SeedInvest, so we started back about 6 years ago. We were involved in a movement to change 80-year-old US securities laws in the US to make it possible for startups to raise capital over the internet for the first time. That's now known as the 2012 Jobs Act. And then we spent the following few years working closely with the SEC and FINRA and others in DC to take the Jobs Act and actually work it into final rules, which are now live today. And the Jobs Act really not only made startup fundraising possible online, but it also really made security token offerings possible for the first time as well. It did that through a few different things. First, it just gave clarity that you could raise capital over the internet for a startup or a token offering. Secondly, it removed the 80-year ban on general solicitation so that startups could actually raise money publicly and advertise them. And then lastly, it opened up the ability to invest in startups or security token offerings to the other 98% of Americans for the first time. A little bit about us at SeedInvest. So we have about a little over 200,000 investors as part of SeedInvest. We are a highly vetted platform, so historically we've had over 25,000 companies that have started applications to raise money on SeedInvest, and we've accepted just 1% of those companies. We do our own independent due diligence and vetting of all the deals before listing them, and we operate our own wholly owned broker-dealer that we started about 3.5 years ago. Now talking about crypto. So I think a lot of people in this room probably know this already, but whether sort of everybody in the space likes it or not, crypto regulation is coming. And so I think it's important for everybody that's in the space to really truly understand all the different intricacies of securities regulations and how they might affect them. The SEC is clearly starting to be more verbal about this and have sort of taken the stance that whether tokens have utility or not, it doesn't mean they're not going to be deemed securities. Another thing that I'm going to talk about is that it's not just the SEC that people need to sort of pay attention to. The states in the US are also important people that will regulate the space that you need to think about. Okay, so here I'm basically going to talk about if you're doing a security token offering in the future, what are the different securities exemptions that you can rely on? And high level, your goal if you're doing a security offering for a security token or startup is you don't want to register with the SEC. And you don't want to register with the SEC because it's built for billion-dollar publicly traded companies. It's not built for early-stage security tokens or for startups. So you want to make sure that you avoid registering with the SEC. And this is a list of all the different exemptions to having to register with the SEC. First, you have traditional 506B under Reg D. That is a way to raise capital from accredited investors, but you need to do it privately. So you can't advertise the fact you're raising capital. You can't talk about it on Telegram. Can't tweet about it. So that probably does not fit very well into doing securities offerings. So your better bet, which most people are doing now, is using 506C under Reg D, which is part of Title II of the Jobs Act that was passed in 2013. And that enables you to actually advertise the fact that you're raising capital broadly, talk about it on Telegram, et cetera, so long as you verify that the actual investors are accredited. If you are looking to raise capital from not just the 2% of the country that's accredited, but also the other 98%, the non-accredited investors, you have two different options as an offering in the US. You have Regulation CF, as in crowdfunding, or Regulation A+. The advantage of Regulation CF is that it's much quicker and cheaper to comply with, but you can only raise $1 million. So there's a cap of $1 million, which makes it a little bit more difficult for people doing security token offerings. On the flip side, you can utilize Regulation A+, Tier 2. This allows you to raise up to $50 million from accredited investors and non-accredited investors in a 1-year period. But the disadvantages versus a Reg CF is that you need to actually go through an SEC qualification process, which means you have to pull together what's known as a Form 1A, file it with the SEC, turn comments, and actually get it qualified by them. You also need audited financial statements, and you need to make semi-annual financial filings. So again, you can raise more money, but it is more time intensive and costly. The last exemption to registering with the SEC is Regulation S. This enables a security token offering to raise capital from non-US investors, and the types of investors that you can accept and the ability to generally solicit depends on the country that you're offering securities in. If you thought that was complicated, that's actually the easy part. So the tough part for doing security token offerings that I think very few people, if any, have actually really figured out is how do you get these things to actually trade in a regulated fashion, and how do you ensure that there's real liquidity. So if you are raising capital from just accredited investors through Regulation D, which is what most people are doing right now in the US, you have two different options to allow your securities to actually trade. There is 4A7, which allows you to have accredited investors actually repurchase your securities through secondaries. However, there are a few different drawbacks to this. One, you cannot generally solicit, so you actually have to have a pre-existing relationship with the people who are buying your tokens. Secondly, you have relatively onerous financial disclosure requirements in order to comply with 4A7. And then lastly, as I mentioned before, it's accredited investors only. So one of the big challenges will be, can you actually provide sufficient liquidity with just accredited investors? So because of that, in 4A7, you can do 90 days after you actually do your offering. In addition, there's 144, and that allows someone who's doing a security token offering to allow accredited and non-accredited investors to be able to buy their shares on the secondary market. 144, however, has a pretty big sort of challenge that I'm going to talk about in a second. You can also allow non-accredited investors and accrediteds to buy Reg A plus shares or Reg CF shares, but they also have the same sort of challenge that I'm going to talk about in a second as 144. What's that challenge? So this is something that I feel like almost nobody is really talking about in the space right now. There are a lot of people talking about forming ATSs, et cetera. I don't think many people have actually figured this problem out, and it's the blue sky problem. What blue sky means is if you are relying on any of the security exemptions I mentioned to raise capital in the US, the states are preempted, meaning you don't have to go to each of the 50 states and sort of make sure that you're allowed to offer securities to residents in that state. That does not apply for secondary sales, which is a big deal. So if you want to use the vast majority of the securities exemptions I mentioned, you actually have to kind of look state by state and figure out the ways to have shares traded, and the rules are different and they're complex in each state. So the only exemptions from blue sky is basically 4A7, but that's accredited investors only, as I mentioned. Or if you actually have your shares traded on the NYSE or NASDAQ, do you not have to deal with blue sky? But right now, that's really not an option for anybody, and we'll see if it becomes one. But in the meantime, this is something that is a real issue that people are going to have to really start thinking about. There's one other issue that I don't really see a lot of people talking about right now, and that's called 12G. So 12G basically requires a company to register with the SEC, which again, you don't want to have to do if you trip certain thresholds. So if you have over $10 million of assets and you have 2,000 holders of record or 500 non-accredited holders of record, which I think pretty much every token offering probably has at this point, you have to register with the SEC. That's a big problem. Not a lot of people talking about it. Reg A Plus is a little bit lower of a bar, so it gives you a little bit more flexibility if you're doing a token offering, but it's still going to be challenging for people. And again, this and blue sky are things that people should start really thinking about if they want liquidity in the space. If you've done a token offering in the past and you haven't actually checked all the boxes I just talked about, which I'm assuming is most people, if not everybody, you have a problem. Based on just working with the SEC over the last 6 to 7 years, I can tell you that they're probably not going to take the opinion that if you violated securities laws, they're just going to let you off the hook if you accidentally did it. So in addition to that, your investors all are going to have a permanent put option on your company back to you and back to the company, which means 3 years later, they can ask you for their money back if you actually violated securities laws. So people will need to actually go back and fix this problem. And the way you fix the problem is you offer what's called a right of rescission. And that's basically going back to the original investors and offering to give them their money back if they want to. Quick problem with this is that you can't use Reg D because you have non-accredited investors. You can't use Reg CF because it's too small. You can't use Reg S because you've gone out to some US-based investors, and you don't want to do a registered offering because it's costly, it takes a long time, and you have to comply with Blue Sky. So what I think the silver bullet solution to this is using Regulation A+ to do a right of rescission and to fix your offering if you did it in the past. Reg A+ is a good vehicle because you can do up to $50 million per year. You can go to accredited and non-accredited investors. You can advertise, and you don't have to deal with the states or Blue Sky. So I think I'm out of time. I know I just talked through a lot of stuff, but I do think it's important for anybody that's in this space to really make sure that they understand the different securities regulations. And we've been, at SeedInvest, we've been funding companies within the securities laws for the last 6 years. And we'd love to be helpful if anyone has any questions. Thanks a lot.